There is legislation under consideration in Congress right now that could impact 175 million credit cards in America, not temporarily suspend them, not reduce the limits, but potentially close them completely. And the people who may lose their cards first are the ones who rely on them the most. Seniors on fixed incomes, people carrying medical debt, anyone with a credit score below 740. I am not talking about something that might happen years from now. The President of the United States has publicly supported this. The legislation has bipartisan support in both the Senate and the House, and the banking industry has already informed Congress on the record exactly what they anticipate doing if it passes. They would close accounts, not thousands, not millions, 175 million of them. I am going to walk you through exactly what is happening, why the mathematics behind this makes mass account closures probable, what a closure does to your credit score and your financial life, what a second piece of legislation moving through Congress at the same time will do to your rewards programs, and the 5 specific steps you need to take right now to protect yourself before any of this goes into effect. If you have a credit card in your wallet, the next 20 minutes could save you from a financial challenge you did not see coming. Let me start with what actually happened, because most people have only heard the headline, and the headline sounds like good news. On January 10, 2026, President Trump called on Congress to cap credit card interest rates at 10% for 1 year. He framed it as relief for hardworking Americans who are drowning in credit card debt. And on the surface, that sounds like the best financial news you have heard in years. Here is why. The average credit card interest rate in America right now is 28.7%. Some cards charge over 30%. If you are a senior carrying a balance of $8,000, which is close to the national average for people over 60, you are paying roughly $2,200 a year just in interest charges. That is $183 a month. That does not reduce your balance by a single penny. It just goes to the bank. A 10% cap would cut your annual interest cost to $800. That is $400 back in your pocket. So why am I telling you this is concerning? Because what sounds like relief for you is a significant challenge for your account. Here is the part that nobody on television is explaining. Credit card companies are not charities. They are not government services. They are private businesses that exist to make a profit. And they make money in the 2 primary ways. The first way is by charging interest on balances that people carry from month to month. About 60% of all credit card holders in America carry a balance. For seniors over 62, that number is 43%. The second way is through interchange fees, also called swipe fees, which are charged to merchants every time you use your card. Between those 2 revenue streams, credit card companies generate hundreds of billions of dollars a year. Interest income is the larger of the 2, and it is specifically how banks offset the risk of lending money to people who might not pay it back. Here is how that risk calculation works, and this is the key to understanding everything that comes next. When you apply for a credit card, the bank looks at your credit score and assigns you a risk profile. If your score is 780 or above, you are what the industry calls a prime borrower. The bank knows based on decades of data that people with your credit profile default at a rate of about 2 to 3%. That is very low. The bank can charge you 15 or 18% interest and still make a comfortable profit, because hardly anyone in your risk category fails to pay. But if your credit score is 620, you are in a different category entirely. People with scores in that range default at rates of 8 to 15% depending on economic conditions. The bank needs to charge you 25 or 30% interest to cover those expected losses and still make money. That is not greed. That is the mathematical reality of risk-based lending. Now here's what the rate cap does to that math. If you cap interest at 10% and the expected default rate for a borrower is 12%, the bank loses money on every single dollar it lends to that person. Not maybe, definitely. The bank cannot charge enough interest to cover the losses it knows are coming. So the bank has exactly one rational response. It closes the account. It is not personal. It is not political. It is arithmetic that a 7th grader could do on a napkin. The Electronic Payments Coalition, which represents Visa, MasterCard, JP Morgan, Chase, Bank of America, and virtually every major financial institution in the country, published a detailed analysis in February 2026. Their conclusion was stated plainly. A 10% cap on interest rates would result in account closures or credit line reductions for nearly 90% of current credit card users. 90%, that is approximately 175 million Americans. The American Bankers Association released their own independent analysis and arrived at a similar number. They found that between 74 and 85% of all open credit card accounts nationwide would be closed or have their credit lines drastically reduced. Their estimate is that between 137 million and 159 million cardholders would lose access to their current credit. Whether you use the higher number or the lower number, we are talking about the largest involuntary reduction in consumer credit access in American history. Now, I need you to understand who gets impacted first because this does not affect everyone equally. If your credit score is above 740, you are likely safe. Banks can still profit from lending to you at 10% because your default risk is low enough to make the math work. You might see your credit limit reduced and you will almost certainly lose some perks, but your account will probably survive. If your credit score is between 670 and 740, your account is at serious risk. The bank will run the numbers on your specific risk profile and make a business decision about whether they can afford to keep you. Many accounts in this range will be closed. Some will survive with drastically reduced limits. It depends on the bank and your specific history. If your credit score is below 670, I need to be direct with you. Your account is almost certainly going to be closed. The math simply does not work at 10% interest for borrowers in this risk category. There is no version of this where the bank voluntarily loses money to keep your account open. Think about who falls into those categories. Seniors on fixed incomes who carry small balances to cover prescription medications or utility bills between Social Security payments. The average American over 65 carries about $5,000 in credit card debt. For many of them, that balance is not from reckless spending. It is from choosing between filling a prescription and paying the electric bill and using a credit card to cover whichever one they could not afford that month. People who went through a medical emergency and put hospital bills on a credit card because they had no other option. The average cost of a 3-day hospital stay in America is over $30,000. Even with insurance, the out-of-pocket portion can be devastating. Young adults just starting to build credit, who have thin files and low scores, not because they are irresponsible, but because they simply have not had enough time to build a history. Military families managing finances across deployments where communication gaps and logistical challenges sometimes lead to late payments that damage credit scores. These are not irresponsible people. These are people using credit exactly the way the system was designed. But here is where I need to explain the cascade effect, because losing the card is only the beginning of the impact. When a credit card account is closed, whether you close it or the bank closes it, your total available credit drops immediately, but your existing balances on other cards stay exactly the same. That changes a number called your credit utilization ratio, and this is one of the most important numbers in your entire financial life. Credit utilization accounts for roughly 30% of your credit score under the FECO model. It is calculated by dividing your total credit card balances by your total available credit limits. Let me give you a real example. Say you have 3 credit cards. Card A has a $10,000 limit and a $3,000 balance. Card B has a $12,000 limit and a $4,000 balance. Card C has an $8,000 limit and a $2,000 balance. Your total limit is $30,000. Your total balance is $9,000. Your utilization is 30%, which is right at the recommended maximum. Now Card C gets shut off by the bank because of the rate cap. Your limit drops to $22,000. Your balance stays at $9,000. Your utilization just jumped to 41%. That 11-point increase in utilization can drop your credit score by 30 Rs to 50 points, almost overnight. And here's the difficult part. When your credit score drops, the interest rates on your remaining cards can go up. Your auto insurance premium can increase because many insurers use credit scores in their pricing. Your ability to rent an apartment can be affected because landlords check credit. Your ability to refinance your mortgage, which could save you hundreds a month, becomes harder or impossible. One account closure starts a chain reaction that reaches into corners of your financial life you never expected. And for seniors specifically, there is an additional layer of impact that almost nobody talks about. Many seniors use credit cards as their primary emergency fund. They do not have $10,000 sitting in a savings account. They have a credit card with a $10,000 limit that they can use if the furnace breaks or the car needs a repair or a medical bill arrives unexpectedly. Take away that card, and you have not just removed a payment method, you have removed their entire financial safety net. The alternatives are payday lenders charging 300 to 400% annual interest rates title loans that put their car at risk, or simply going without the medical care or home repair they need. That is the real human consequence of this policy that nobody in Washington seems to be calculating. Now, I need to tell you about the second bill, because it makes everything I just described even worse. The Credit Card Competition Act was reintroduced in January 2026, with bipartisan support from Senators Durbin and Marshall, with a related version in the House from Representatives Lofgren and Gooden. President Trump endorsed this one too. He posted on social media calling swipe fees an out-of-control ripoff. And here is the thing. He is right about the fees. The average American family pays nearly $1,200 per year in swipe fees that are buried in the price of everything you buy. Every time you buy groceries, gas, clothing, a meal at a restaurant, the merchant is paying Visa or MasterCard between 1.5% and 3.12% of the transaction. Merchants do not eat that cost. They build it into their prices. So you are paying swipe fees, whether you use a credit card, a debit card, or cash. $200 a year from every family in America. The banking industry collects over $111 billion a year from these fees. The Credit Competition Act would force banks with over $100 billion in assets to allow their credit cards to be processed over at least 2 competing payment networks instead of only Visa or MasterCard. The idea is simple. Competition drives fees down. Merchants pick the cheaper network. Fees drop, prices drop, everyone wins. That is the theory, and it makes economic sense on paper. But the banks have been very clear about what they anticipate doing in response. They will cut your rewards, your cashback, your travel points, your airline miles, your purchase protection, your extended warranties. All of those programs are funded primarily through the interchange fees that banks collect on every swipe. If those fees get cut through forced competition, the revenue that pays for your rewards disappears, and banks are not going to replace that revenue out of their own profits. They are going to eliminate the programs. For many seniors, cashback rewards are not a luxury. They are a meaningful part of their monthly budget. 2% back on groceries, 3% on gas, 1% on everything else. Over the course of a year, that can add up to $300, $400, $500 in real savings. Take that away, and you have effectively given seniors a reduction on top of everything else. Now think about what happens if both of these bills pass in the same legislative session, which is entirely possible given that both have presidential support and bipartisan backing. The rate cap closes your account if your credit score is below 740. The Competition Act eliminates your rewards even if your account stays open. You either lose the card entirely, or you keep a card that no longer gives you any benefit for using it. And in both cases, the people who are least equipped to absorb the impact, people on fixed incomes, people with limited savings, people who are already financially stretched, are the ones who bear the brunt. Let me be very clear about my position. I am not telling you these bills are inherently bad policy. Capping predatory interest rates that trap people in cycles of debt is a legitimate and important policy goal. Creating competition in a payment processing industry dominated by 2 companies is economically sound. These are real problems that deserve real solutions. But the way these bills are structured right now, the consequences will fall disproportionately on the people they are supposed to help. That is not an opinion. That is what the industry's own data shows, and waiting until the bills pass to figure out how to protect yourself is a mistake you cannot afford to make. So here are 5 specific steps you should take right now, regardless of what Congress does. Step 1, check your credit score today, not next week, today. You can do this for free at annualcreditreport.com, which is the only federally authorized source for free credit reports. You can also check through your bank's mobile app or website. Most major banks now show your FICO score for free. What you are looking for is simple. If you are above 740, you have a buffer, but you should still prepare. If you are between 670 and 740, you are in the risk zone and need to take action immediately. If you are below 670, assume your accounts will be affected and start preparing alternative access to credit right now. Step 2, pay down your credit card balances as aggressively as you possibly can. Every dollar you pay down reduces your utilization ratio, which protects your credit score and makes your accounts less likely to be targeted for closure. Here is the strategy that matters most. Do not focus on paying down the card with the highest total balance. Focus on the card with the highest utilization percentage. A card that is 80% utilized is doing far more damage to your credit score than a card that is 30% utilized. Even if the 30% card has a larger dollar balance, bring your highest utilized cards below 30% first, then work on getting everything below 10%. People with utilization under 10% have average credit scores above 800. Step 3. Do not close any credit card accounts voluntarily. I need to be very specific about this because many financial advisors tell people to close cards they are not using. Under normal circumstances, that can sometimes make sense. Right now, it is the worst thing you can do. Every open credit card account, even one you never use, contributes to your total available credit. That available credit keeps your utilization ratio low. If you voluntarily close a card with a $10,000 limit, you just remove $10,000 from your available credit and push your utilization up. Instead of closing unused cards, use each one for a small purchase once every 3 to 4 months and pay it off immediately. That keeps the account active, prevents the bank from closing it for inactivity, and preserves your credit line. Step 4. Build an emergency fund that does not depend on credit cards. I understand that this is easier said than done, especially on a fixed income, but even small amounts matter. Start with $25 a month in a separate high-yield savings account. Online banks like Marcus, Ally, and Discover are currently paying between 4 and 4.5% annual interest on savings accounts. That is not going to make you wealthy, but it creates a small buffer that belongs to you and cannot be taken away by a bank's business decision. Over 6 months, that is $150. Over a year, $300. That might be enough to cover a car repair or an unexpected medical co-a without needing to reach for a credit card that might not be there anymore. Step 5. Establish a relationship with a credit union. Now before you need one. Credit unions are fundamentally different from banks. They are member-owned, not shareholder-owned. They are not publicly traded. They do not face the same quarterly profit pressures that drive banks to close accounts at the first sign of risk. Many credit unions offer credit cards with interest rates that are already well below the national average. They offer more flexible lending criteria. They often have lower fees and better customer service. If your account at Chase or Bank of America gets closed, having an existing relationship with a credit union gives you somewhere to turn. But credit unions also have membership requirements and application processes. Do not wait until you are desperate. Open a basic savings account with a local credit union this month that establishes your membership and creates a relationship you can build on later. And I need to give you one final warning. Watch for the scams. I say this in every video because it is that important. Every single time there is a major financial policy change or news story that affects millions of people, the scammers mobilize within days. You will receive emails that look like they are from your credit card company telling you your account is about to be shut off and you need to click a link to verify your information. That is a phishing scam designed to steal your login credentials. You will get phone calls from people claiming to be from Visa or MasterCard asking you to confirm your card number and expiration date. That is identity theft. You will see advertisements on Facebook and Instagram for companies that promise to protect your credit score or save your accounts for an upfront fee of $200 or $500. Those are scams. Your real credit card company will contact you through official channels, through the app, through your online account, through United States Postal Service mail. They will not call you demanding immediate action. They will not text you with a link to click. They will not create artificial urgency. The number one sign that you are being contacted by a scammer is the feeling of panic. If someone is making you feel like you need to act right this second, stop, hang up, delete the message. Contact your bank directly through the number on the back of your card. Here is the bottom line. 2 pieces of legislation with broad political support are moving through Congress simultaneously. One would cap interest rates in a way that makes it mathematically challenging for banks to maintain most credit card accounts. The other would cut the revenue that funds every reward program you rely on. Neither has passed yet. But the fact that both have presidential endorsement and bipartisan backing tells you which direction this is heading. The time to prepare is not after these bills pass. It is right now. Check your credit score today. Start paying down your highest utilized cards. Keep every account open. Build savings outside of credit. Establish a credit union relationship. These are not dramatic measures. They are common sense financial steps that protect you regardless of what Congress does. If the bills pass, you are ready. If they do not pass, you are in a stronger financial position anyway. There is absolutely no downside to preparing. If this was useful, share it with someone who carries a credit card balance. That is more than half of America right now. Total credit card debt in this country just hit $1.28 trillion. That is the highest number ever recorded. The people carrying that debt are the ones most at risk from what is coming. Subscribe because these updates keep coming throughout 2026, and every one of them could affect your bottom line. Drop your questions in the comments. Your question might become the next video.